I'm going to show you how an executive can do everything right with their incentive stock options, follow every rule, hit every deadline, and still end up with a $132,000 tax bill in April on stock they haven't sold and can't access. If you've been granted incentive stock options or ISOs, you've been handed one of the most tax-advantaged equity instruments in the tax code, a potentially significant difference in taxes on a large gain just from following the rules correctly. You've also been handed one of the easiest ways to accidentally create a significant tax bill on stock you can't sell. It's a short list of financial instruments where the tax code gives you something valuable and a clean way to blow yourself up with the same piece of paper. This is one of them. I'm Klemm. I'm the founder of Inflection Point Wealth Management. This is video 3 in our informational series on executive compensation. Be sure to click below to subscribe so that you can see the rest of the series. In the first video, we walked through RSUs. In the second, we covered non-qualified stock options. This one is ISOs, which are structured completely different from NSOs and come with one complication NSOs don't have: the alternative minimum tax. Same framework as before: what it is, where does it go wrong, and what do you actually do about it. An incentive stock option is the right to buy a set number of shares of your employer's stock at a fixed price for a fixed period of time. That fixed price is called the strike price, and it's set at the fair market value on the day the option is granted. 4 numbers define an ISO grant: the stock price, the grant size, the vesting schedule, and the expiration date. Most companies use a 3 or 4 year gradual vesting schedule, and most ISO grants expire 10 years from the date of the grant. You'll often see ISOs at private companies, venture-backed startups, pre-IPO tech companies, and privately held growth companies. But they also show up at public companies alongside other forms of equity compensation. The mechanics and the tax rules are the same either way. The examples I'll use today lean toward a private company setting because that's where the AMT issues tend to hit the hardest. But if you're at a public company with an ISO grant, the framework still applies to you. Here's why ISOs get so much attention. If you follow the rules, an ISO can give you long-term capital gains treatment on the entire spread between your strike price and the sale price. What the rules require is this: you exercise the option, meaning you actually buy the shares at the strike price. Then you hold those shares for at least 2 years from the grant date and at least 1 year from the date that you exercised. If you hit both of those marks when you sell, it's a qualifying disposition. If you miss either, it's a disqualifying disposition, and the spread gets taxed at ordinary income, just like a non-qualified stock option. To put numbers on it, same $500,000 of gain, 2 different tax treatments. As ordinary income, the top of that gain hits the 37% federal tax bracket. As a long-term capital gain, you're looking at a 20% plus the 3.8% net investment income tax. That's a spread of roughly 13 percentage points on the same dollars. And on a $500,000 gain, that's the difference between writing a check for around $178,000 versus around $112,000, about $66,000. Same stock, just different holding periods. Now here's the piece that trips everyone up on the way to claiming that prize: the alternative minimum tax. The AMT is a parallel tax system. Every year you're doing 2 tax calculations, whether you realize it or not, and you pay whichever one comes out higher. In most years, for most people, the regular tax calculation is higher, so AMT doesn't come into play. But the moment you exercise an ISO and hold the shares past the end of the calendar year, the spread between the strike and the fair market value, called the bargain element, gets added into the AMT calculation. Not the regular one, just the AMT one. That can push AMT above regular tax, and suddenly it matters. This is by far the biggest pitfall I see with ISOs. Here's how it plays out. You're an executive at a private company. You've been granted 10,000 ISOs with a $5 strike price. The company's current 409A valuation for common stock is $55. Your options are fully vested, and you decide to exercise and hold because you believe in the company and want to start the holding period for favorable tax treatment. You write a check for $50,000 to exercise, $10,000 at $5 a share. So far, so good. Then tax season hits. The spread between your strike price and the current common stock value is $50 per share. On a $10,000 share exercise, that creates $500,000 bargain element. You didn't sell anything, you didn't receive cash, but for AMT purposes, the $500,000 is an adjustment item. Assume you also have $500,000 of salary and are married filing jointly and take the standard deduction. Under 2026 rules, your regular taxable income would be about $467,000, and your regular federal income tax would be about $103,000. On the AMT side, you start with regular taxable income, add back the standard deduction, and then add the $500,000 ISO adjustment. That puts AMT at about $1 million. For 2026, the AMT exemption for married filing jointly is $140,000, and it phases out at higher income levels. But in this example, you still get the full exemption. That leaves about $859,000 subject to AMT tax rates. The tentative minimum tax comes out to about $235,000. The AMT you owe is the difference between tentative minimum tax and your regular tax, about $132,000. That is a real tax bill due for stock you haven't sold. The important nuance is that this AMT is not always a permanent cost. ISO AMT often creates a minimum tax credit that carries forward indefinitely and may be recovered over time in future years, to the extent your regular tax exceeds your AMT. But the recovery can take years, and the cash outlay happens now. That's why exercise and hold decisions need tax planning before the exercise, not after. Here's the flip side of the AMT trap, and it's a pitfall in its own right. Once you understand the AMT problem, one response is to exercise early, while the spread between your strike price and the fair market value is still small. The smaller the bargain element, the smaller the AMT hit. Done for the right reasons, this can be a smart move. You lock in a low AMT basis, start the long-term capital gains clock early, and if the company does well, the whole gains can end up at the capital gains rate. Here's the problem. You've just put cash into a stock that may or may not appreciate. And if you're at a private company, you've put cash in a stock you can't even sell. Every dollar you exercise is a dollar that's no longer in your savings, no longer in your diversified portfolio, and no longer available for anything else. If the company goes sideways for 5 years, or the next funding round comes in at a lower valuation, or the business hits a rough patch and never fully recovers, you've got real money parked in a position that isn't doing anything. So exercising early to manage AMT is a real tool, but it's not a free one. The decision to exercise isn't just a tax decision, it's a concentration decision, an illiquidity decision, and an opportunity cost decision. You have to size it to your actual conviction in the company and to the room in your balance sheet. Here's the third pitfall, and it's the one most ISO content never names, because most ISO content is written to get you to optimize for the qualifying disposition, not to ask whether the path to get there actually fits your life. The whole reason ISOs get so much attention is the qualifying disposition, the long-term capital gains treatment on the spread if you clear the 2-year from grant and 1 year from exercise holding periods. That's the prize. And because the prize is so valuable, the default advice everywhere you look is to chase it. Exercise, hold, clear the clocks, take the lower rate. But here's the thing. You don't have to. The ISO tax treatment is a tool. It's not an obligation. And for some executives in some circumstances, deliberately taking ordinary income treatment could be the better call, even though it looks worse on paper. Let me walk through why. Scenario 1. You have real goals on the table. Your oldest is a year away from college, and the next 2 aren't far behind. Maybe you've been talking about buying a cottage for the family, or finally paying down the mortgage, or freeing up cash to start a business on the side. You also already have meaningful equity in the company. Across RSUs that have invested, stock you've accumulated in the ESPP, maybe other option grants. The ISO grant in front of you isn't your only exposure. It's additional exposure, on top of a pile that's already concentrated. The chase the qualifying disposition play says exercise, hold through the clocks, optimize for the low tax rate, and trust the stock to cooperate for the next 18 months. The alternative is to exercise and sell in the same calendar year. That's a disqualifying disposition. The spread gets taxed at ordinary income, you pay the IRS their cut, and you walk away with cash in your hand. Cash that funds the college accounts, buys the cottage, or gets diversified into a portfolio that isn't tied to one company's stock price. You gave up the long-term capital gains rate, you also gave up the AMT overhang, the illiquid position, and 18 months of watching the stock to see if it cooperates. For an executive whose plan is served by the certainty in cash today, that's a very reasonable trade. Scenario 2. You're 57 years old, your plan is already funded, and the ISO grant is material but not existential. The qualifying disposition path might save you somewhere in the neighborhood of $60,000 on a $500,000 spread. Real money. But it also means holding a concentrated position and an illiquid position for another 18 months while everything you actually need is already locked in. An exercise and sell at ordinary income rates closes out the position today, takes the tax hits, and moves the money into your diversified portfolio where it supports your plan. You gave up $60,000 of tax savings. You also eliminated a path where a bad outcome on the stock could cost you a lot more than $60,000. For someone whose goals are already funded, certainty can often beat optimization. Scenario 3. You have a view on the stock. You think the current price is as good as it's going to get, or you're not confident with the company will be in the same position 18 months from now. The qualifying disposition pays off if the stock holds steady or appreciates. At long-term capital gains rates, even a flat stock comes out ahead of ordinary income path. Where it stops paying off is when the stock drops meaningfully during the holding period. If the price falls 40% while you're waiting to clear the clocks, the tax savings don't come close to making up for the erosion. An exercise and sell today takes the ordinary income hit, but locks in today's prices. Sometimes that's worth it. The point is this: the ISO tax treatment is there to be used when it fits, not chased when it doesn't. The executives I see get this wrong are the ones who let the tax tail wag the dog, optimizing for the qualifying disposition as if it were the goal, instead of asking whether the path to get there actually fits their life. Once you separate the decision from the tax code says this is the best treatment, therefore I must want it, a lot of different answers open up. So how do you actually use ISOs well? Here's the framework I walk executives through. Step 1 is to know your 4 numbers cold, plus the current fair market value. At a private company, that's the 409A. At a public company, it's the trading price. Step 2 is to model both tax calculations before you exercise anything, regular tax and tentative minimum tax. What you're looking for is the gap between the two. That gap tells you a very specific thing. It tells you how much bargain element you can generate before AMT starts to apply. That point is called the AMT crossover. For example, a married couple filing jointly with $300,000 of income and no other AMT adjustments might see an $8,000 gap between their regular tax and their tentative minimum tax under 2026 rules. At the 26% AMT rate, that translates to roughly $30,000 of bargain element they could absorb that year without owing AMT. The exact numbers vary by income, by deductions, and by what else is on the return, but the principle holds. You're looking for that window and using it deliberately, year after year. Step 3 is to exercise your conviction in your balance sheet. A 35-year-old bullish on the company with decades of earning years ahead can take more risk than a 55-year-old whose next 10 years of cash flow are more precious. There's no universally right answer. There's only a match between the size of the bet and the shape of your life. Step 4 is to model both tax paths before you commit: the qualifying disposition path and the ordinary income path. For some exercises, the qualifying treatment is clearly worth the AMT and the holding period. For others, a fully funded plan, an uncertain stock, a bargain element too big to cash flow, the ordinary income path may actually fit your life better. The answer depends on your circumstances, not on which path looks best on a tax return in isolation. Step 5 is the plan for the 90-day window before you leave. Almost every ISO grant gives you 90 days to exercise your vested ISOs after you leave the company. After that, unexercised ISOs expire, and anything exercised beyond 90 days converts from an ISO to a non-qualified stock option and loses the preferential tax treatment. If there's any chance of a job change in the next year or two, know your exercise cost and your AMT exposure ahead of time. Step 6 is to understand the AMT credit. If you do end up paying AMT, that credit is an asset. Track it and make sure you and your tax preparer are actively using it in future years. Step 7 is to coordinate with the tax professional before every material ISO decision. This is one of the few areas of tax law where the timing of a single decision can swing your tax bill by 6 figures. Model it before you act, not after. Here's the through line on ISOs. They're one of the few places in the tax code where doing something right in advance can save you real money, and doing something wrong in advance can cost you real money. But the right answer isn't always to chase the favored tax treatment. Sometimes it is. Sometimes the right move is to deliberately pass on it. The executives who get the most out of their ISOs aren't the ones who optimize every exercise for the qualifying disposition. They're the ones who treat each decision as its own planning event against their actual circumstances and let the tax code serve the plan rather than the other way around. Next video in the series will cover employee stock purchase plans, or ESPPs, which look simple on the surface and have their own set of surprises underneath. If you have vested ISOs and you haven't modeled your AMT crossover for this year, the exercise decision you make before December 31st determines the tax bill you pay next April. After year end, the only thing to do is pay it. This channel is built for high-earning professionals and executives, delivering content on navigating complex financial decisions, equity compensation, tax strategy, retirement planning, and concentrated wealth. If these topics are valuable to you, be sure to subscribe so that you get more free content. Thanks for joining in. We'll see you next time.